Hello and welcome to this month's edition of our 5 and 5 series. My name is Antonio. I'm Head of Business Development here at AZ Sestante. And joining me again today is Mitch Healey, our investment analyst here. G'day, Mitch. So Mitch, please let our audience know what actually happened in markets in September.
Well, the headline for September was obviously the US instituting its first rate cut of the year. Boded pretty well for equity markets, pretty much across the board actually. So US equities finished in positive territory. Europe also finished in positive territory, but it was really a story around banks, industrials. The European Central Bank obviously held on rate cuts, and that sort of stabilised the market. Inversely, when we look closer to home, the Australian market was actually down for September. Now that was really a story around inflation, a bit of pickup there. The market's now worried about whether the RBA is going to continue the rate cutting cycle. Importantly for us, we recognise that a little bit early on. We started to shift our interest rate position over to global markets, which boded quite well for us. Now, look, the story ahead obviously is around the sort of US government shutdown.
I was going to ask you about that. It seems to be all over the media and all over the news.
Exactly. So what does it mean for our portfolios? What does it mean for our thinking at the moment?
Yes,
it's obviously, a pivotal moment for the US. We think, it's more or less a storm in the teacup in many ways. You're obviously going to have some impacts around data releases. Now, when you look, the US Central Bank is obviously looking at the data and whether they can institute further rate cuts. That might put some pause, at least in the short term. The second impact is obviously, the US federal government is a big employer within the US. So, you might see some numbers sort of revised, particularly around the GDP side of things. But we think, naturally these things sort of come to a resolution within the medium term.
Awesome. So in recent developments, and our thesis in the past was that we thought the US Feds were going to cut rates a little bit quicker. If they do put a pause on that, will that have any impact on our portfolios?
Look, it is something we're looking at quite closely, but we think, more or less our thesis is correct in the fact that, the Fed has been a bit reticent to cut previously. In fact, this is their first rate cut of 2025. So we think in many ways they're actually behind the 8 ball relative to most other central banks in that respect. So we're happy to still play global markets, particularly the US, through our active managers.
Wonderful. And then when we look at the global economy and everything that's happening, and obviously, with rate cuts declining, what are the emerging trends that we're seeing, and are there opportunities that we are identifying?
Absolutely. So when we look at portfolios today, the key for us is to stay diversified across, both region, asset class, to make sure that our portfolios are robust. So when we look today, within our equity sleeve, we're obviously overweight global opportunities. Now that's a view within Australia that, earnings growth, profits driving these companies is relatively benign. Our market is essentially 4 banks, a few miners, and some opportunities elsewhere. Within Australia, we're obviously playing that sort of X20 space. So, smaller companies where we think, the stories are much better, the earnings growth is much better. Within global markets, we're leaning away from the US at the moment. Again, leaning into some of these policy risks. We just see some sort of embedded risk. And then the second thing is the US is very expensive, both in terms of historical terms and absolute terms to other markets. We absolutely love Europe at the moment. We're starting to lean into the emerging market trend. Again, what happens is when you get a weakening US dollar, it bodes quite well for those emerging market regions.
Wonderful. And so when we think about any standouts within our portfolios, what have been the standouts in the last month or two?
Absolutely. So fixed income has been a real hotspot for us at the moment. All of our active managers have outperformed their respective benchmarks. Again, we think that active management, particularly within fixed income, pays dividends over the medium term. Within the equity sleeve, our Aussie managers have again done a really good job over the recent term, outperforming their respective benchmarks. The sort of discussion point for us at the moment is around global equities. Now, for us, our thematic that we're leaning into, particularly in the dynamic portfolios, is the quality tilt. Now, importantly, when you get the AI thematic running so hard, we're obviously not going to compete in some of the more frothy parts of the market. Importantly for us, we've got to stick to our knitting, make sure that our portfolios are diversified, and importantly, protecting on the downside is what we're looking at now.
Wonderful. And we get the feedback every month, and we seem to be getting it right most times. If we had that crystal ball, looking forward, what do you see playing out in the next month or so?
Look, I think the headline for us over the next sort of month or so is really around inflation and whether we see any pickup there. The real risk for us and portfolios everywhere is essentially the idea of stagflation, which is moderating economic growth against a backdrop of increasing inflation. Now, that doesn't bode well for most asset classes. In fact, it pays to be defensive in that environment, and that would start to rethink how we're positioning our portfolios.
Wonderful. Well, thanks, Mitch. And we hope you got a lot of value out of this month's series of our 5 and 5. If you've got any questions or you've got any things you'd like raised for the next month, please email us at invest@azsestante.com. Until then, goodbye. Thank you.